Yes, Michael, you can start now.
Okay. Hello. Thank you very much for inviting me to speak at your future summit. I would very much have liked to be there with you right now, but sadly, Boris Johnson, our Prime Minister, isn't really letting us out of our homes, let alone to travel internationally. So I'm afraid this is the best we can do. But hopefully, I can deliver a good summary of our views on where we see the global economy and how the recovery might play out. Obviously, at the moment, there is much excitement about a possible vaccine that could return our lives to normal by perhaps April or May of next year. But I think it's important to recognise that life will not return to normal as it was before the vaccine, before the virus, and certainly the global economy will not be returning to the where it was before the virus outbreak at the start of this year. So what I want to do in this presentation is, first of all, just set out where the global economy is right now, look at some of the near-term prospects, and then touch on a couple of longer-term issues, which I think will be more permanent consequences of the COVID-19 crisis. So if the organisers could put my presentation up now, please. So, first of all, where are we in terms of the global economy right now? This chart just shows for various economies the path of GDP over the course of this year so far. The first, I think there are three things to take away from this particular chart. First of all, of course, China is the only economy that will grow significantly this year, the only big economy that will expand this year. It is already larger than it was at the end of last year. It recovered very quickly from an early lockdown and is now growing at 4 or 5% annual rate. So China has undoubtedly done very well in terms of returning to growth from this in the aftermath of the virus. Secondly, there are one or two emerging market economies I put on this chart. There's a bit of a divergence in their performance, as you can see, ranging from Brazil down to India, which has suffered one of the biggest falls in GDP. But the main point here is that unlike in the global financial crisis 10, 12 years ago, emerging markets have suffered recessions along with developed markets. This has been a truly global recession. And the third point I wish to make here is that obviously there has been a recovery in the third quarter after the lockdown-induced contractions in the second quarter. Economies have bounced back, and as you can see, the big economies, the US, Germany, France, Japan will also be included in this, are all now round about 3.5%, 4.5% smaller than they were at the end of last year. So they have recovered a lot of the ground that was lost in the first half of the year when the pandemic was at its peak. So on the face of it, it looks as though things are on track for a sustained recovery, almost V-shaped in terms of getting back to where activity was at the end of last year. But unfortunately, that's not going to be the case. First of all, in the short term, the virus has come back, and there is a second wave, especially in Europe. The chart on the left illustrates the scale of the renewed infections that we're now seeing across Europe, and that has triggered renewed lockdowns in most of the big economies in Europe. We're currently in one in the UK, and Germany, France, Italy, Spain, etc. have all entered into lockdowns of varying degrees of restrictiveness, not as severe as the first lockdown, and also very much likely to be of shorter duration. But the effect is clearly going to be to bring recoveries to a halt in Europe. The UK will probably contract by about 4%, I think, in the fourth quarter, and the euro area will show a similar decline in activity. In the US, which is shown on the right-hand side, also the infection rate has also shown a resurgence. There haven't been lockdowns there yet, but latest data on mobility, etc., suggests that the economy there has more or less stalled. It's flat. So with the US flat, Europe in contraction, I think it's fair to say that the global economy is running out of steam in the fourth quarter. There is certainly no continuation of the recovery we saw in the third quarter. There is some good news, of course. Also on this chart, you can see in India, Brazil, South Africa, the infection rates have fallen, and of course in Asia, in many areas, in many countries in Asia, infection rates are negligible. But in the short term, clearly this is going to restrict and put economies into reverse. It will not last. The second wave will clearly diminish, certainly as we head into the Northern Hemisphere spring next summer, regardless of the progress on the vaccine that we're currently anticipating. But it's the sort of longer term issues, I think, which are much more relevant here, and the labour market is going to be key, and in particular the unemployment rate. This chart shows projections of unemployment for the US, UK and the euro area, but it applies across the advanced economies really. The US saw a spike in unemployment rates because its fiscal support was concentrated not so much on wage subsidies keeping people in employment, but on direct transfers to households. But the main message is that unemployment is going to rise across developed economies in coming quarters, simply because the level of demand is so much weaker than it was a year ago. It's simply not possible to avoid rising unemployment, regardless of the degree of support that might be put in place in the short term. And the question is, when might unemployment, having risen over the course of the next 6 to 12 months, when might that begin to fall and fall back to where it was prior to the crisis? And that, I think, is going to be a long haul, because there have been structural changes in economies. Demand has shifted from sectors, and those changes don't take place quickly, as well as the fact that I think there will be an underlying weakness in demand for a prolonged period, and that will keep unemployment high. And one of the reasons for that relatively high unemployment, I think, will be a continued caution among households and companies to increase their savings. This chart is US household savings. I only use this because they provide monthly data, but as you can see, the savings rate shot up earlier this year as lockdowns took effect. Incomes were supported by fiscal transfers, spending was cut back, so inevitably savings went up. Savings have come back down again as restrictions have been lifted, but I think it's unlikely that savings rates for households will come back to where they were before the crisis, because there's I think a renewed caution among consumers. There's a fear of unemployment. As the previous chart showed, unemployment will be rising in many areas. That undermines consumer confidence and tends to encourage higher savings rates from consumers. And of course, higher savings means less consumption. And I think you'll see a similar sort of behaviour from the corporate sector as well. Reduced investment because of demand uncertainty, and higher savings, partially, of course, because the corporate sector has taken on a lot more debt during this crisis, and increased savings from the corporate sector, retention of profits will be required to repay that debt. So I think reduced private sector savings is going to be a long-term effect of this crisis, even if the health crisis is over within a few months. But that leaves a big role for government, and this will be another long-term effect of this crisis, is that the role of the state, which has already increased dramatically with the interventions that have taken place to support people's incomes during the crisis. I think fiscal policy will continue to be a dominant influence on policy, on economic policy. This chart just shows advanced economies' budget deficits. And as you can see, budget deficits this year will be much bigger than they were during the global financial crisis. During the global financial crisis, the policy response was primarily a monetary one. Central banks cutting interest rates, quantitative easing, and fiscal policy provided support, if you like. This time round, it's the other way. It's the response has been predominantly fiscal, with support from central banks, support from monetary policy. And I think this is going to be an ongoing feature, because central banks are going to keep interest rates at their lower bound. Quantitative easing is in place, but its effectiveness is becoming questionable. So monetary policy is going to provide a supporting role to active fiscal policy, a return to active fiscal policy, as basically governments offset the higher savings from the private sector by running bigger deficits, stiff saving on their part to support overall demand. So a greater state involvement in the economy and greater use of fiscal policy to manage the economies, I think, is going to be one of the consequences of this crisis. So this deficit, I don't think, will come down particularly rapidly, and we certainly won't have the austerity that we had in many countries post the financial crisis, where big efforts were made to reduce debt levels. That argument has shifted to a greater tolerance of higher debt. And this chart just illustrates the higher debt levels that we're seeing, obviously both in advanced economies, which are shown on the right-hand scale, where debt this year will be around about 130% of GDP. But because interest rates are so low, government bond yields are negligible across most advanced economies. The cost of servicing this debt is very low, and simply there is no pressure on governments to rebuild the public finances, and this will allow them to continue to pursue significant deficits and active fiscal policy for the foreseeable future. But moving on to another issue, emerging markets, where, as I said before, one of the features of this global recession is that it has been truly global. That the World Bank, for example, estimated that I think 93% of all countries in the world are in recession or have been in recession during 2020, compared with around about 60% during the global financial crisis, because emerging markets have been fully involved, unfortunately, in this recession. And they have suffered particularly because of their reliance on commodity exports, or exports more generally, which have suffered badly during the crisis. Overseas visitors for some emerging markets are very important. Those have virtually disappeared for now. And remittances from overseas workers coming back into economies have also taken a major hit, as other economies have gone into downturns and have furloughed or laid off a lot of workers. So there have been those. I think those three factors have been particularly damaging for emerging market economies. And of course, despite their rising debt levels, they don't have the fiscal capacity has not been there in the way that advanced economies have had to support demand and incomes. This chart from the IMF just illustrates the difference between the fiscal policy response that we've seen from advanced economies relative to emerging markets and low-income economies. As you can see, the advanced economies have done a multiple of what emerging markets have been able to do in terms of supporting demand and sustaining people's and companies' incomes, and that has been obviously a big a big factor in sustaining or stimulating the recoveries that we have seen in the second half of this year in many advanced economies. Emerging markets have not been able to do this. Plus, in many cases, obviously, their healthcare systems have been put under great pressure because of the COVID health crisis, the source of all the problems. So this has been an additional negative influence for emerging markets. Having said that, obviously, throughout the course of 2021, I think it's quite likely that we will see a recovery in the global economy, especially if there is an effective vaccine. That will give a boost to confidence, and the global economy will re-establish a fairly reasonable growth path. But I still think it's going to be possibly well into 2022 before overall economic activity has returned to where it was at the end of 2019, which is obviously when this crisis, well, before the crisis before this crisis hit. That may be brought forward, as I say, if there are multiple vaccines and there is a rapid return to normal consumer behaviour. But the evidence from previous pandemics is that it does take a long time, once these crises are over, for behaviours to return to their pre-crisis state, if in fact, even if they do. So I think it would be very premature to sort of anticipate a quick return to life as it was, or economies as they were before the crisis. And I think there are certain trends which this crisis has accelerated, which will just simply continue as a consequence of this of what has happened over the last year. And I think the most important of these is the issue of globalisation. This chart just shows world exports as a percentage of world GDP. Over the 25 years up to the global financial crisis, there was obviously massive increase in world trade. This benefited emerging markets in particular, which were engaged in a catch-up process with developed economies. Since the global financial crisis, this has trended flat. And of course, in recent years, you have seen an increase in protectionism. Obviously, the US-China trade tensions for a start, but also since this crisis, you've seen talk of resilience in supply chains, not efficiency across global supply chains. This talk of domestic resilience has become bandied around by, for example, the US, the European Union. China's talking about a dual circulation model, which basically implies a greater reliance on domestic producers. So I do think one of the consequences of this crisis will be a gradual decline in globalization, if you like, a decline in the trend of trade as a percentage of GDP, and that is, I think, a bad news for. Well, I think it's bad news for the global economy, but obviously, given that the emerging markets were major beneficiaries of globalization, it is a concern, I think, for the catch-up process of emerging markets towards developed economy levels of income. So that's a quick run through of where ACCA we see the short and the longer term. In summary, public spending is going to increase. State involvement in economies, which has been massively increased this year, will be reduced, but it's not going to go back to pre-crisis levels. Fiscal policy, which has become absolutely dominant in the policy toolkit this year, will remain dominant over monetary policy, and caution among households and companies in the private sector will, I think, persist for some time, and that means that the fiscal policy, the government, will be will be the supplier of demand, if you like, demand of last resort. So on that basis, there is optimism in terms of there are policy levers that will work. The global economy can get back growing on a reasonable trend, and we will eventually return to where we were at the end of last year. But there are some trends, other trends, which I think are less beneficial, and issues of where globalisation goes, I think, is perhaps one of the more significant ones, which is a consequence of this crisis. So that's it. Thank you very much for your attention. These are my contact details. If you have any questions, please by all means contact me, and hope the rest of the summit is a great success. Thank you very much.